important. Many of you have left your respective portfolios to come here and share with us this morning on a very good engagement that I am looking forward to.
Lamahle sinemukele lapha eHappy Valley lapho sita khona ne-live broadcast khona ke emsakatweni we-channel Yemaswati. Lapha ke sita nayo live broadcast iyo forum lebitwa nge-Asset Management Thought Leadership Forum lapho khona i-Old Mutual lapho ke ibuka khona kutshala timali kuze futhi itshalele amakhasimende phecelezi ama-investors ikhuluma nawo ke ama-investors ngokuthi ingabe ngiphi indlela labangafukula ngayo emabhizinisi abo baphinde batshalelwe kahle timali Old Mutual. Lokhu kulandzela ukuthi kube nekuphazamiseka ke kumnotfo wemhlaba wonke ngawo umkhuhlane we-COVID-19 kanye nayo ke impilo selokhu ke ichubeke njalo lapha eveni lase-Ukraine emkhathini walo live le-Ukraine kanye ne-Russia. Kanti ke tikhulumi tanamuhla tiqhamuka khona ka-Old Mutual lapho inzabe khona umnumzane BROOKE loqhamuka kuyo Old Mutual Group khona ke eveni laseNingizimu Afrika longena losimenyo lesicavile ngethemba ukuthi nitakufokotela ngekusakata kwethu lokulandzelako njeke khona nyalo.
To make this program a very, very worthwhile experience. So allow me to recognize the FSRA CEO who is among us and came early and should not leave early. And I also want to recognize our special guest who I just reliably learned is here for a very, very, very important assignment. BROOKE, Portfolio Manager at Old Mutual Investment Group. Please give him a round of applause. I look forward to hearing from him because I read his biography or his profile and it is long. It is very long, but it is also long with very important things of achievement. So I look forward to hearing from you, Mr. BROOKE, and I hope that you enjoy sharing with us this morning. Ladies and gentlemen, I want to also recognize all of you who are here in your respective spaces. I know that you are important. I had a conversation earlier with someone who reminded me that she's responsible for a very large sum of 100 million investment. Thank you very much. I hope it's invested with Old Mutual, of course. So we recognize your presence here this morning, and we hope that we will give you something to take home or to your offices and share. Right now, it is the honor and privilege to invite a very knowledgeable man to give us the official opening remarks. There is no cabinet minister here and no MP, so you don't have to worry about what we call protocol. We're all equal in this space. We are about asset management. We are about money. So it's cool, if I can put it like that. Ladies and gentlemen, please put your hands together for Mr. Sifiso Sibanze, the Old Mutual Business Development Specialist.
Thank you very much, Mr. MC Bingo. Good morning to all our esteemed invited guests today. Sanbona. You're all welcome to this thought leadership. I don't want to keep leaning. Clearly, I'm taller than Bingo. Hello. You're all welcome to this thought leadership event that was organized by Old Mutual Asset Management. My name is Swisom Tsebande. I work within the Asset Management Division. You are all welcome, and thank you for finding the time to actually come here. The program could no longer could not be a success without you actually coming here this morning to be with us and spend this morning with us. Please clap hands for yourselves. Ladies and gentlemen, we have not forgotten the evil clutches of COVID-19 that destroyed businesses, that destroyed lives, and I'm sure that each and every one of us sitting here today, you have been affected one way or the other. You lost a friend, you lost a relative, especially during wave 2. Now, in the midst of all that, while we were still wearing our masks, February 2022, we woke up to news that Russia had invaded Ukraine. But it's important to understand how it actually all began. Ladies and gentlemen, the mainstream media has reported various information about this, but let me just share a few things that I think you will probably find very informative about the invasion of Russia into Ukraine. In 1962, USSR at that time, which was the Soviet Union, deployed its missiles in Cuba. Now, Cuba is only 100 miles away from Florida, which is the United States of America. The president at that time, John F. Kennedy, did not take that kindly. There was actually an uproar in America in such a way that the president was advised to strike USSR as a result of this. However, after very intense negotiations, he chose a more diplomatic way of dealing with it. And USSR agreed to dismantle their weapons and return them back to USSR. Now, soon after that, John F. Kennedy made an announcement, public announcement, that he would not allow any offensive weapon into Cuba. Not in America, into Cuba. Why? It's too close to America. Let's fast forward, ladies and gentlemen, 2014. I'm sure you still remember it very well. In 2014, we heard that Putin invaded Ukraine and actually annexed Crimea. Why did that happen? Because in 2014, a democratically elected government was actually overthrown with the influence from Europe. And the current president took over. The previous, or rather, the one that was actually overthrown, the previous president, was not in support of an agreement that was going to make Ukraine have closer ties to Europe, or rather, he was favoring Russia. Obviously, he was kicked out, overthrown, and he actually found exile in Russia. The current president, Zelensky, took over, who is more prone to Europe. And that's the reason why Putin decided that he was going to annex Crimea, which originally had actually belonged to USSR, but it was transferred to Ukraine in the 1950s. You remember that Ukraine became an independent state in 1991. Now, in 2021 rather, what happened is there were efforts by the current government to now join NATO, which is a military wing that is foreign to Russia. The same reason why John F. Kennedy refused to have Russia set up its base in Cuba is the very same reason why Putin refused to have Ukraine join NATO. And that's why he began the process of trying to take over Ukraine. Ladies and gentlemen, I am not a relative of Putin. Neither is all mutual in support or trying to broker an energy deal from Russia. But it was important for us to find out some of the information that is actually readily available out there and be able to have some thinking around it. We actually condemn the actions of Putin. So many lives have been destroyed. You watch it on TV all the time. It makes you wonder how long it's going to take for Ukraine to actually be rebuilt and get back to where it used to be. Ladies and gentlemen, we are here for the Thought Leadership Forum. Peter Brooke is here. He's going to be, unraveling more, telling us more, making us understand more. We trust that you will find it worthwhile while you are listening and participating. Thank you very much. You're all welcome.
Well, good morning. I'm very excited to be. See, I'm a bit shorter now. But I'm a bit more practiced with this than he is. I'm very excited to be in Eswatini. It's my first time ever. And I arrived with the rain, and rain is good for farmers, not so good for small aeroplanes. And I want to take what's happening and convert it into tangible lessons. And the truth is, in terms of thought leadership, I like the fact that Safisa spoke about COVID, because if I'd come 2 years ago, the presentation would have been on COVID. Now it's on Russia. And in 2 years' time, maybe it's on Taiwan. Or it will be on something different. But the lessons that sit behind the environment is what's critical. And that's how you can manage money, and that's how you can grow wealth. So I want to take the current environment and expand it into lifelong lessons that we can all use in our day-to-day lives. So one thing I would highlight though, just on the picture on the left, those are oil wells. And this is really one of the most important things about this war, is the price of energy and what it's doing to the world economy. And as you would know, in Swaziland, it costs more to fill up your tank. So that's money out of people's pockets, and that has an impact. It also impacts inflation. So if we have a look at the world, there's really 3 areas that matter. And that's America, Europe, and China. Everything else, so I was just speaking, we've just invested in Thailand in our funds. But it's a small market, it's a specialist area, we can make some money there because tourism is reopening. And that's our job, is to look for opportunities. But actually, in terms of the big drivers of the world, this is the 3 big drivers. And if we look at the world at the moment, it doesn't look very good. So it's chaotic, in fact. Things are moving. So China is actually in a recession. They've deliberately taken their property market and broken it. One of the reasons for that is because it was the fastest growing property market in the world in terms of growth. So prior to COVID, I would fly to China probably once every 3 years, and every time it's just astonishing. If you see the development, the new cities, and you land and you think, it's impossible that this airport will be full. Next time you arrive, it's full. So they have deliberately chosen to take a recession. At the same time, we've just seen Xi Jinping voted in for his 3rd term. That effectively, he changed the rules. This is the first time since Mao this has happened. And effectively, it makes him the emperor. He is the sole person driving the power. He's pulled power towards him. He's changed the cabinet around him. or the Politburo. And so you have one man with huge amounts of power in the second largest economy in the world. And we're seeing its impact in terms of markets. So just yesterday, Naspers, which is the largest company in South Africa, fell by 17% because of the changes in politics in China. Then we come across to Europe, and Europe's big problem is actually the war, because they rely on power from Russia, and particularly gas. So because the Europeans are very keen on environment and ESG, what they did is they shut down all their coal plants and their nuclear plants, and they said gas is cleaner. So then they drove all of their factories. So if anyone here drive a BMW? Come on. Those factories are driven by Russian gas. And the price of that has just gone up 10 times. And the Russians are no longer supplying gas through their big pipeline, Nord Stream 2. So Europe, as a result of this, is paying up. And when we talk about Eskom, this is 10 times more price. They've increased the price by tenfold. So Europe is going into a recession, relatively mild, but it's going to be tough. And then we come across to America. America is still okay. But because of the inflation that has come out of that higher oil price and the higher food prices, they're hiking interest rates. And as everyone knows in terms of markets, higher interest rates is bad news. So what we've seen is bonds go up from 1% to 4%. And we've seen short rates, or the federal, and this is all around the world. So whether it's South Africa or the only place in the world cutting interest rates is Turkey. And they're crazy. As a result of that, that's causing problems in the housing market and in asset markets. So what we've got is we've got a decline in bond prices and we've got a decline in equity prices. So the US market has fallen about 25%, just to give you a sense. And that's the biggest market in the world. And as a result of that, there's nowhere to hide. So almost all assets are down. The only asset that is making you money is US dollar cash, because the US dollar is very strong. So the world is looking like quite a treacherous place at the moment if our three biggest blocks are in trouble. So actually, you probably want to be down in Swaziland avoiding these problems and hoping for a good rainy season. And this is actually one of the important things, is some of the winning countries have actually been in the south. So if you think about South Africa and platinum and palladium, because Russia is a massive producer of PGMs. If they get sanctions, they can't supply those. You think of Brazil in terms of food, because Ukraine and Russia are big food producers. So you're actually starting to see higher food and commodity inflation, which is good for the South. And it's good for those countries that are primary producers with strong agriculture, strong mining, and these sort of areas. So there is a silver lining in this for some parts of the world. But I want to take that environment and say, we've got this tough environment. How do we navigate it? How do we think about it in terms of portfolios and investing? And the first lesson is time is your friend. Because think about this. Every day the market goes up and down. So if you invest on a daily basis, 45% of the time you lose. Now that's much better than the casino where you lose 60% of the time. So the odds are in your favor because it's 55. But if you're worried about losing, half the time you basically lose. So this is this picture here. But if you invest for 1 week, it goes to 42%. And this is the entire data series for the South African equity market for nearly 100 years. So this is the data for 100 years. 1 month, 38. 1 quarter, 30. 3 years, 6%. 5 years, 10 years, no chance of losing money ever. Over 90 years of data. So that's an important lesson, is time is your friend. So when you're worrying about what happens tomorrow and what happens today and this price goes up and this event happens in the world, just relax, breathe out and use time. Time is your biggest ally. And the reason for that is very simply, this is the same graph, and now this is in real terms, so we take inflation out, and I'm going to talk a lot about inflation as an important lesson. You can see, despite the volatility, it goes up. And that's what you want. You want to be on this trend line with something that's going up. So that's the first lesson, is time is your friend. The second lesson is we've just had a big sell-off in equity markets. What do we do about that? And I think when people look at shares, they go, well, if it's falling, then I must sell my shares. But if you were offered a 2-for-1 special at the Spur, you go to the Spur to get, it's cheaper. Why wouldn't you go? And it's very simple, is when prices fall, that creates your opportunity. So now, this is the returns by year for the South African equity market for all of those nearly 100 years. And you can see sometimes it's pretty bad, and sometimes it's amazing. That was nearly a 90% return. But I've highlighted 2021. Why is that? Because COVID was 2020. You had a big event where markets crashed. What did you need to do? You had to buy shares. It was one of the best opportunities that we've had, and we made so much money for our clients by buying shares. We were buying shares, I bought how many shares at 20 Rand, and I sold them for 60 Rand. 200% up in 3 months because the market was panicking. And that's your opportunity to buy. 2009, what happened in 2008? We had the global financial crisis. Then we get the big opportunity. 2001, we had the tech bubble bursting in 2000. After crashes, you get recoveries. Half price sales, you buy. So that's the second lesson that I want people to take away from this. So falling prices is good news, particularly for anyone in a pension fund where you have a monthly payment. So every month you're buying more shares at the lower prices. And this is what we look at. So this is the valuation work. This is the real expected returns. We do this every 6 months. And what we're looking for is when these numbers go up, we're getting more return in the future. And if I redid this today, my returns on equity are up another 0.5% real. My returns on bonds are up another 0.5% real. On global bonds, it's up to 2%. So huge, huge changes in asset prices means that our future returns will be better. So that's the second lesson, is falling markets means better returns in the future. The third lesson is inflation. And this is exactly due to the war in Ukraine that Sifiso spoke about. So the oil price shot up to $120 a barrel. The gas price went up 10 times. The wheat price doubled because Russia and Ukraine make most of the world's wheat. And actually, the other very important thing they make is fertilizer, which then goes into next year's crop, which means food prices are higher for another year. And this is the United States. This is America, the largest economy in the world. Look at this inflation rate. This is back 30 years. It never gets here. That is extreme inflation. And the reason that that's important is because if time is your friend, inflation is your enemy. It's why we talk about returns in real terms as opposed to in nominal terms. Because we often forget, so if inflation is 10% and you're getting 8% from the bank, you're going backwards. You're getting poorer every day. And I'll give you some examples of this. So if you just take a 6% inflation rate, you've got 10,000 Rand today. In 10 years' time, that same amount of money is worth 5,500 Rand. You've lost 4,500 of your money because you can't afford to buy the same basket of goods. Does that make sense? So I'll turn it around into the basket of goods. So today, if you go shopping, and you have a basket of 1,000 Rand, what did it used to cost? So you look like quite a young audience. Who's the oldest person here? I'm guessing nobody's at 80 or 105. Look, I'm 50 years old. So that basket, when I was born, was 14 Rand for the same basket of goods. That's how much my mother spent when she went on the shop, where I'm spending 1,000. That's a big problem. 30 years ago, I was at university. It was 1 Rand a beer. So you have to think in real terms, and you have to protect yourself from inflation. So, and now how do we do that? And the answer is very simple. In the long run, your protection from inflation is equities. It's shares. And the reason for that is because the profits of the companies grow. Pick and Pay increases the prices. Therefore, they make more money. So they can protect their profits. So going into this crisis, our biggest purchase and one of our biggest holdings in our top 10 was Sasol. So when the oil price goes up, we make lots of money. So you protect the portfolio from that crash, from that higher inflation. And what I've got here, when we think about investing, you can think about the time that it takes to double your money. But now, I'm talking about double your money in real terms. So taking out the inflation. And if we look at the long data, for equity, you can double your money in 10 years. In cash, it takes 86 years. And the reason for that is because the return on cash is very low relative to inflation. So I'm going to show you the real returns. So cash gives you 6.7, inflation 6, it's only 0.7. So if you're investing, trying to grow 0.7, it's like a cow with no milk. It's like you're squeezing and nothing's coming. So that takes you 86 years. This, on the other hand, gives you 10 years. And you can see then that if we have a period of higher inflation, which looks like we are heading into in terms of the world as a whole for the next decade, you need to have something to protect yourself, and you need to have equity. How am I doing on time? Cool. I don't want him to lose his paycheck. So that was one of the big takeouts from these global events and the war, was the impact of inflation and how do we think about managing for that. One of the other things is the impact of surprises, because a year ago, definitely 2 years ago, nobody thought that Putin would invade Ukraine. And he did. And if you're invested in Russian shares, you've just lost a lot of money. And this is, you've got events that take place all the time. I know it's not good to laugh at other people, but has anyone looked at the politics in the United Kingdom? There was Somebody posted a meme, and he said, my son has seen 4 chancellors, 3 home secretaries, 2 prime ministers, and 2 kings, or two royal heads, and he's only 4 months old. But, what's happening in the UK, this is the 11th largest economy in the world. And it just shows that bad politics can have a big impact on markets. So if you are invested in the UK bond market, now this is normally, in terms of pensions, as you get older you want to be safer, you want to go more into bonds, and bonds is your safe space. You've lost 35% of your money in UK bonds. This is a well-rated, you've done much better in South African bonds, for the record. So the point is that in this world, we always have surprises. And how do we then think about that? Because we don't know, by definition, the surprise is a surprise. We don't know where it's coming from. So we might be worried about something and we can protect the portfolio, but when something comes out of the blue, like COVID, then you have to adjust. And the way we protect the portfolios is through diversification. Very simple. Don't put all your eggs in one basket. And once again, if we go through this long data series and we look at history, we know that equity is the best performing asset class. That's what I just showed you earlier. But it's not always the best asset class. There's other times where other assets do well. So 46% of the time it's SA equity, but sometimes it's gold, sometimes it's bonds, sometimes it's cash. 1 year out of 8, cash is the best performing asset class. So you don't want to be there forever because it doesn't give you the high return, but sometimes it helps protect your portfolio. So I run a fund which is an aggressive fund. It's trying to grow fast, so it's got a lot of equity in it. Coming out of COVID, I was at 95% in equity. Now I'm at 72% in equity. And the reason for that is I'm protecting the portfolio, so I have more cash. So sometimes you need to play defense when the environment's tricky, which it is right now. It is very tricky, as I showed you in terms of that world map. So this, if any of you have got very good eyes, we call this the Smarty Box. And this is just the annual returns. So each year, who's the winner, who's the loser. And the point that I'm trying to make is not to say which one is which. It's to look at the fact that the colors jump all over the place. Sometimes it's the worst, sometimes it's the best. And that is why you need some diversification to adjust for that uncertainty, for that volatility. And it's also why you want active asset allocation to say that sometimes I want to have more cash and sometimes I want to have more equity. Sometimes, right now, we are buying some global bonds. We haven't owned global bonds in our portfolios for 10 years. And the reason for that is they gave no return. They didn't give a good real return. But now that they've sold off, they're suddenly starting to give a real return. So if we put our clients' money there, we're going to get something back. So there's 2 lessons there. One is diversification, but hidden behind it is another lesson, which is you want to move where that opportunity lies. Sometimes play offense, sometimes play defense, and that's what we do. That's our core job. Now, this has got nothing to do with Russia or Ukraine at all. I just threw this one in as a last lesson for the day. And it's a very simple question. We have a hard-working young man, Sifiso, who starts working at 20. He works for 10 years, and every month he saves 1,000 rand, and he puts it into the Old Mutual Balanced Fund. And the Old Mutual Balanced Fund gives a return of 10% per annum. We've actually given a bit more than that in the long run, but that's not a bad proxy. Now then you get the lazy kid who goes off and parties for 10 years, and then he starts working at 30. Now Sifiso, unfortunately, his father gets ill, so he has to go back to the farm, and he stops working at 30. So he doesn't invest again. Now, I am saving. How long, how many years does it take before I make as much money on my investments as Sifiso? So every month I'm now putting in 1,000 rand, but I've started 10 years behind. Sifiso had 10 years head start, he stopped. Now I start and I go. How long till I catch him? This is a question you have to answer. I'm very serious. I'm not going anywhere till somebody shouts out some numbers. What helps is if lots of people shout lots of numbers, then I'm not going to pick on anyone. I'm not going to say, no, you said this. Almost all people get this wrong. So just relax. How many years till Peter catches up with Sifiso? Yes, sir. He leaves it in the fund. Of course, yeah, absolutely. Absolutely, because as you know, in investments, you can't exit your pension fund, otherwise it's very bad. So he's leaving the money to we can't let him win just with 15. 20, 30, this is now like an auction. It's like who can go highest. So the correct answer is never. Peter will never be richer than Sifiso.
Sounds good.
So the reason is, you take that money, you invest it. So he has 12,000. After 10 years, he's invested 120,000. But he's also grown that money every year. So that's maybe 160,000. That money, 160,000 times 10%, means that every year, he's growing by 16,000, whereas I am only adding in 12,000. I can never catch him. That is the power of compounding. And what compounding does is it makes you very rich. So if you just grow at what the equity market has done at 13.8%, 1,000 rand invested, 10 years later it's 3,600. 20 years later it's 13,000. So now, if you're rich and you put in 1 million, it's 13 million. So that's my last lesson for the day, which is to say, the power of compounding is really, really strong. But embedded in that lesson is you can't take your money away. You have to leave it to work for you. You can't give your cows away as lobola. You can't cancel your pension policy. So all of these lessons are embedded in a book which we put out once a year called Long-Term Perspectives. If you want to get the link to that, it's on our website, but also contact the team here and they can give it to you. This is actually this presentation. If you send the presentation out, if people want it, I don't know if you're going to do that, but you might want to do that. There's a link embedded in it which will take you to the presentation, to the book, Long-Term Perspectives, which has all of those lessons there. So, in summary, the world is a challenging place. The truth is, it's always challenging. But actually, we always come out okay. And in that time of challenge, there's some big important lessons, which is time is your friend. Buy shares when they're cheap. Inflation is your enemy. You need equity and you need to diversify. And the last and most important one is keep compounding your money. You have to save and you have to put it away, and in the long run, it will make you rich. It's an amazing, amazing thing. Thank you all very much for your time and attention. I hope that was useful.
Please may we give a bigger round of applause for Peter. I thought that was very fascinating, and I must accept, for a second I thought, Peter, there was going to be a wild throwing of numbers when the question came, because these people deal with our money, and suddenly there was a serious hush. Mr. Bell, you want to look into that? You really want to look into that? But also, I sense that some people were doing the calculations quietly. Okay. Ladies and gentlemen, I think that was a very useful presentation. Firstly, I was going to say that Peter has mentioned some very important things that we should be aware of. And I just picked two. The first one being, of course, it's important to know your money is in good hands. And I can tell from his presentation that my money is in good hands at Old Mutual. And I'm not saying that you guys must then look at me and pickpocket me outside, but yeah. And obviously the second part is Peter is the guy that I want to hang out with, so we can talk strategy, so we can look at markets, so we can know what's going on. And for that, I think it's important to actually now hear from the person who must now tell us, because when the shocks happen all over the world, now we want to know, are we safe? What do we do? How do we balance the situation? Inflation is our enemy, we've heard. So there's only one way to find out how good we can be in the future. And I want to introduce my cousin, I want to introduce Mr. Ngamiso Njalinjali, who is the FSRA CEO, to give us a very brief presentation. Did I say brief? To give us a presentation on the Eswatini perspective. Please give him a round of applause as he comes on.
So I always have this challenge as short guys. Old Mutual, so Pumelelo, Babelo. Thank you, Mr. Bell, for organizing this talk. We had quite some interesting back and forth, and it's I find myself grateful to be here. My cousin, my newly found cousin, and we had a brief one on that. And we also are grateful to have the fourth estate. They haven't given us a good riding of late as the FSRA. As Ukraine is taking all the hits on the ground, the papers are not saying nice things about the FSRA. And we do understand, of course, that the fourth estate just reports the news. They don't make the news. So we are always kept honest that in whatever we say and whatever we do have to at least maintain a nice decorum and stability in our sector. I had also prepared a few notes on the war and its own impact, but the history lesson that I've received from Mr. Nsbande sort of make my notes a bit light, and it's always interesting. I was hoping that Peter would also put up a picture of how the Russian economy has fared during the war. There are certain interesting elements that we are not getting from mainstream media. When Russia was sanctioned, Mr. Bell will realize that of late we are talking very strong on anti-money laundering issues, which they also have their own history and background post the 2001 attacks in the US. The G20 economies and the Financial Stability Committee quickly put together a very nice pack of frameworks that were seeking to identify the flow of funds and realize who owns what and where it ends up, to try and pick up who finances terrorism. So we heard a very interesting one in our space. 2011, we put up our own anti-money laundering framework legislation. We received a mutual evaluation in 2010. We had to quickly as well amend in 2016 that legislation to bring in now more stringent controls into the flow of funds. Now, this is not a story that Old Mutual likes, because it then puts in an interesting element that as we're sitting around as trustees of funds, we always require that note to bring to our office to test fit and probity. That as Mr. Dlamini in the Central Bank Fund, who are you? Do you have the right capacity to make these interesting decisions? Do you understand what the war in Ukraine would bring to the pension fund that you make decisions on? So we have evolved. And I'm trying to bring this perspective to then say, when Russia was sanctioned early in the year, they had to be taken out of the global financial payment system, SWIFT, which made it very difficult for them to do trade with their main partners. But the interesting element there is the resilience that the Russian economy has demonstrated. This hike in food prices and agricultural implements is doing the opposite in the economy. I find that at times we act on a protectionist position, and we let you guys don't have much opportunities to invest. But it brings us to a safer, well, a relatively safer, because there are those moments when we also allow certain things indirectly to come into our space and wreak havoc. So when the financial system in Russia was sanctioned, we saw a lot of trade going to the other side, to China and that region. The Russian ruble became strong. I don't know if the Lilangeni got weak or the ruble became stronger, but it continued. And that is where my interest would have been to see if Peter would have delved into that space, because the media is not not our media. Our media is fine. I have to carry some favor with Umzala. Yeah. So it's these global frameworks and what happens beyond our borders then tend to give us what we term as best practice. When we then sit and say, what can you invest and the amount that you can invest offshore? What is the balance? What proportion should be kept local in Eswatini? And we always have interesting engagements with industry to say, but there are no returns. What are we to do? The regulator seeks, to some extent, within reason and within safety caution, relax a bit of some rules. For example, pension funds legislation, the 2005 legislation, which was also an interesting year in the early 2000s when Eswatini decided to do some financial sector reforms, and a number of financial sector laws were enacted, and some have already been amended now and regulations have come out. And we also see another wave now coming from the ministry saying there's a merger of sorts. So it is financial sector reform seeking to entrench certain behaviors and conduct that is for the benefit of the country. So when we look at asset allocations and what we need to influence as a regulator, the legislation had said, I'll just pick one element, that pension funds are to invest in listed securities, and the unlisted portfolio should be less than 10% of the total assets. And then you look at our own environment. We have a Eswatini stock exchange. I also moonlight there. It's a side hustle with the exchange. A very interesting development over the past 32 years. We still have the same number of listed equities. And we tell Old Mutual, go and invest in the stock exchange. So they go, they talk to brokers. There's nothing sold there. For me, it's my legacy thing to have 100 shares, and I'll keep it for my son, and my son will keep for his son or his daughter. But nothing happens. So we then relax and say there's a dispensation that we can grant for pension funds to take the unlisted portfolio to 30%. Lo and behold, there is excitement. And then you try looking at what kind of assets are invested in. Are there the returns that we want to report on? Is there the value that we seek? The jury is out on that. So we now have to claw back. How then do we look at it? So we have to then look at the wider economy. The PSPF sometime last year or in 2021, they took out an interest to have a research consultant look at the split and the nature of our economy to see where the opportunities could be. We are also trying, of course, on a smaller scale. You know, the pension fund is at 30-something billion, and we all, in our assets are kind of insane. But we enjoy the levies, Mr. Bell. They come in handy. But we don't have the tools that some of these corporates would have. So we're also trying to pick through the data that we've had since we came into the space in 2007 to see that the 30% local asset that we have required of entities to invest locally, where has it been directed to? Has it realized any value? Has it shown any potential in our economy? Obviously, some of us are tenants of the PSPF, and we see what is happening around the Mbabane Park space. The skyline is changing. It is a benefit. It's been a while, though, since we've seen cranes in Mbabane lifting things, which means, of course, the economy is not pumping as it used to be. So there are initiatives that we should have 50% brought in country on the asset management space as prescribed by the Securities Act of 2010. Now, it requires that the managers themselves, they get to link up with the funds, they get to create these vehicles. On our end, when you speak of the Eswatini Stock Exchange, we're putting the infrastructure. Recently, we've gone live with the automated trading system. We're dematerializing to ensure that it becomes easy to trade in these assets, but these counters have to be available. The regulator cannot create those, and it is up to industry. It is up to those who can be able to speak the right English to the trustees. The trustees should be a bit, of course, they are holding public funds, but they also have to be deliberate. The Minister of Finance creates policy on an ongoing basis, and the 50% was sought to be a deliberate approach. You realize that our returns, the level of returns in Eswatini, can never measure up with what you see in offshore markets and also the South African markets. But there has to be a deliberate action to move and say you are building the domestic space to be able to absorb the investments or the funds that are sitting in the country. And they are a wider as well. We're looking at energy challenges. We're seeing potential to fund some of those issues. Of course, they have to go hand in hand with ESG guidelines to ensure that it's clean energy and clean financing. But we remain cautious. The IMF managing director 2 weeks back said the worst is yet to come. You're talking of unimagined rates of inflation in the US markets, and of course the chaos that is happening in the UK. There were policy and political initiatives that were promised based on economic struggles and challenges. Liz decided to, was the chancellor who lived for less than a few weeks, Kwasi Kwarteng, go out and pump up the economy and issued some tax cuts that were unfunded. Those are dangerous positions that policy makes, and we then are left to pick up the pieces. So when the IMF MD speaks of the worst that is yet to come, it is the lagging effect and the after effect, the snowball effects that are coming post this chaos that we see now. So we are in a better position, Kaz Ngoba. We are very measured in what we do as the FSRA. We try to say little, we try to stay behind closed doors and look at what the entities are returning, and then slowly build and ensure that the circulars that we issue and the practice notes that we issue are in a way guiding the space. Of course, we then have to book a shuttle and go to the South African guys or the Botswana colleagues to listen to what they say so that we don't shoot from the hip. So those regional collaborations that we have as the FSRA, in a way, they lessen the mistakes that we could make and ensure that we keep our decision making and our issues customized to our environment. And as we as well wait to see the effects of the war and COVID at some point scared us a bit. We took a hit of about 3 billion from the PSPF portfolio, but within 6 months to 9 months that was recovered. As a testament to what Peter speaks of buying low and gaining the value over time. So it is for our as we've seen the resilience post-financial turmoil of 2008, we are still encouraged that our fundamentals are strong and our policy framework will be able to resist the damage that the world economy is seeing at the moment. I cannot speak probably, so I know part of your expectations is to share what the regulator is currently working on. I've tried to skim through that, but the main policy area that we are looking at the moment is to ensure that the 50% investment is going to realize some sort of value, but we know that the groundwork we have to do and the consultations we have to be the right ones. On capital issues, Nosmilo, we always have a lovely conversation around that. But those are best practices, and we do look at customizing, of course, to our own environment, because you speak of capital and then it takes the potential to invest and to make contributions and make changes to the economy. So we remain close as the FSRA, and we would like to build the relationships with the entities that we supervise and have oversight over to ensure that their pain and the issues that are emerging in their space, we quickly learn and make sure that we do the right action to respond on those problems and challenges. 5 minutes. Thank you.
Thank you, Mr. Njanjali. Please give him a round of applause. So obviously, just as he was about to get into the actual discussion, he says 5 minutes is over. Ganzi, that's why we want you, Mr. Njanjali, to open up a little bit into what the framework is like, what industry should be looking into, or what you are looking into. But that's okay. I have been told we have a second chance at this conversation. if the CEO allows. Ladies and gentlemen, trustees of note, we are just on time, Peter. By the way, you stepped out. I did say that you are the guy I want to hang out with. I want to have money. So I want all the tips. And I think that all of us here now want that second chance with you. So I'm going to ask you to please join us on stage together with the CEO, FSRA, and Mr. Sifiso, not the judge, but the man of history, clearly. And I don't know if we have microphones for, yes. Mr. Bell, I didn't introduce you to our audience, but I'm going to say this also. We are bonamos. Thank you, sir. Peter, we are just going to try and manage this very efficiently. We do want to have a nice, this is after all a thought leadership forum, so we do have to hear your views. And I think the idea is after all these presentations, we do want to explore more the conversations on what you have shared with us. So I'm going to say, Sifiso, looking at where we are and the history of the global markets and taking from Peter's presentation, compounding, he said, is the best. I have one minor question to ask before you can start your presentation, which is, it seems to me that there's a lot that we can benefit if we know, if we follow the history, if we hear you well. So why do we struggle in terms of our small society in Eswatini to make the right call in terms of investment? What, in your opinion, makes that?
Thank you very much, Stephen. I think you touched a very important question. And, as an old child, so they need to learn the culture of saving and investing. It's a culture that we must develop. Now, developing a culture is not overnight. It takes time. But I think forums like this, not just my own job, but various entities, this gospel needs to be preached, because I think what Peter talked about is quite an important thing. Actually, I remember some years ago, I attended a class where it was demonstrated to us. We were actually using a calculator to actually calculate, because we didn't believe it. And we used the calculator to actually do exactly what he just talked about, to say, I start now. And then someone else starts 10 years after I've stopped, and they never catch up. We did it in various scenarios. We came to the same conclusion, to say it's always better to start now, when it comes to investment. So I think it's for people to get into the habit and the culture of investing, saving, not just for stock fair for end of the year, but looking at the future. One day you're going to retire. One day you would want to have a successful, or should I say, a comfortable lifestyle. And you're going to have to do something about it now, instead of just hoping that one day you will have a windfall, you win the lotto. Thank you very much.
Thank you, Mr. Swanson. Please give him a round of applause for that.
I just want to add something to that. So the secret to a happy marriage is low expectations. But the problem is savings is hard because there's always demands for your money. So, and if you have a lot of money, it's easy to save if you're rich. But the rich become richer because they save. And it's the discipline of saying, I make 100. So the secret to saving and to wealth, to grow your wealth, is just to spend less than you earn. Because the variable that is the biggest variable is your spending. So spend less. That enables you to save more, which enables, at a very simple level, you're not paying interest to the bank on your credit card. And then you get to the better level and you get better and better where you're investing in assets which are then growing for you, and then you can go forward.
Good. Quick tips you can share with us lay people. I'm not an asset manager, definitely. I'm sure that my colleagues here also are not in the space of saving themselves, but they're looking after portfolios. But they can benefit in knowing how.
Sure, that's a very wide question. Like tips as in, I think you should buy a Rhodes Food Group today. Or how to think about money.
Yes.
Okay.
I'm here to ask harder questions though.
So it starts with that spend less than you save. It's discipline, and then once you get to that state, you run down your debt. So paying interest to the bank is a bad idea. Then you need to start saving and investing, and then it's as simple as just a debit order. And then it's the critical point is it goes to that first lesson, which is time is your friend. It's the amount of time that you give it. So if you can give it 40 years or 50 years, and remember, we all have this in our brain that, well, we've got 10 years or 20 years. The truth is, many people are now living to 80, 90. Health is good, the medical system's better. So actually, if I look at this room, let's say the average age is 50, you've probably got 40 years left. So you're not thinking, I've got 10 years, you've got 50 years, so give more time. And it's the amount that you save and the discipline of saving and the time that you save is more important than where you save. But if you're coming to where you save, I don't know what the tax laws in Swaziland are, but if you can avoid tax legally, you should do that. So in South Africa we have tax-free savings, or you have pension funds. Those are better than just going direct. So generally take advantage of that, but go for a simple product that works. So a balanced fund is perfectly good. You don't have to go and try and pick a share or do this. Give it to somebody else. One of the other big constraints for people is choice. If you go to a supermarket and there's 100, well, I like beer, so there's 100 beers, it's hard to choose which one. But if there's 3, it's just easy. You pick the one. So now you can get confused by choice, so you do nothing. So actually, just like, it's okay, buy a product and get going. It's more important to act and to save than to worry too much about this one's maybe a little bit better than that one, or obviously the old mutual product is good.
Obviously.
But don't get too worried about that and get into, so if you don't know what you're doing, ask for help from somebody and allow them to do it. And then it doesn't matter if you pay them a bit of money, because actually you would never do it on your own. So get over that hurdle.
Okay.
And those are those are like really profound tips that are nothing to do with today's the day to buy the China market, or it's just simple rules that I think will help.
And you're saying it's never late to start?
Start today.
Okay. Ladies and gentlemen, before I ask my last question, I'm sure that Ms. Nzabulago over there wants to offer a microphone to someone who has a better question than mine and who has been listening, obviously. So if you have questions, please raise your hand and we will send the mic over to you. But to the policy regulator of note, we obviously, I hear you saying you want to encourage local investment. Is there appetite for that? Do we have what it takes?
Yeah. Well, we're an offshoot of the government, so we always have the focus on the public good. I like a conversation around transport networks, the Gautrain, our own airline, national airline. The conversation gets mostly on profitability. Are you getting the return on the investment that was made? But the government has to look at how they want to ensure that there is ease of transport and congestion is less. So they will invest in a national airline to cut out, well, I can say names, to cut out Airlink or compete with Airlink. They are not supposed to turn a profit, but they are supposed to ensure that the ease of doing business is much lighter. The appetite in our local market, we don't have the assets, but who creates them? We have to have an enabling environment now that says the investment advisors that we license are not doing treasury business for local corporates and transferring those liquid assets to the South African market. We have to ensure that the players themselves are advising proper. The PPPs with the government we've seen picking up on the roads, but there has to be someone who finances those loans and those facilities. And those are the individuals in this room who have the access to control the purse of these pension funds, direct them to the right sectors. Of course, you also want to know that you are getting return. So that is why then you say you allow the offshore, but the South African market, pardon me, we'll talk after, I'll buy you a beer. For many years, we have negotiated a customs union agreement along political lines. So when you look at how the SACU agreement has evolved, 1910, 1960-somethings, 1990s, it has been on major political milestones in the South African market. So when it opened up post-1990s, we suddenly we saw a dip in the economic growth rate of our market. We used to report 7-8% pre-1990s, and when the businesses shifted back to the SA market indirectly polarized our own economy. So we are not going to find a bond instrument that will compete with the South African government paper. So we have to be a bit aware that there has to be some influence and nudging to the right direction to it. Say, create your own. We have slogans, proud South African, but when you come to ours, yes, it will not compete on quality because the inputs, we still have to get them from SASAM to build up on our own products. But there has to be that patriotism, if I may, that says we are direct and we want to make a change. And then, so we split the assets in a way that we are not taking a hit on the entire portfolio, but also ensuring that the domestic market is building and strengthening its base.
Thank you, Mr. Jalajadi. I have two over there. ladies first. It's about time we hear a lady's voice.
Thank you, Mr. Mbeka. Mine is just a question to Peter. I think recently, Peter, we've learned that the conversation in pension funds is now shifted towards enabling savers to access their pension funds early in terms when they have got troubles or life-changing circumstances. I think in South Africa they tend the two-point system. So I think my question is more to say, what impact do you expect that to have on the investment strategies? And also, do you expect that to also affect the way in which you will be managing assets as portfolio managers by individual?
That's a tough question, thank you. So, obviously, the regulator wants to keep pensions to run as long as possible. So they tried to gate it so that you could. They tried to gate it so that you couldn't, and they failed on that. And we've actually got a terrible situation in the public sector, where people were leaving the public sector so they could cash in their pension and then rejoining. So actually, and then when they get paid out, they're getting paid out less. So there's a balance. And a lot of countries, so for instance, Malaysia at the moment for COVID, they allowed big drawdowns, but then you have to rebuild it. So do you have a higher rate? So there isn't, if we look around the world, I mean, the Australians with their superannuation, where they've got compulsory pensions and that's, you cannot take it out. That asset pool has grown, it's the fastest growing asset pool in the world. It's amazing savings power. It's making the Australians rich. So the logic is good. The unintended consequences are bad. Like, can you find a middle ground that works? That's pragmatism. In terms of how does it affect us, it doesn't actually affect us that materially, because the truth is, when we manage the money, it's a pool of money. So the fact that there's maybe one person who's just started and has 50 years to go, one person who's got 5 years to go, and one person who's pulled out, we're managing the money towards the objective. And that objective is real wealth growth after fees. And then it's how much risk are we taking for that. So I don't think it won't change the way we think about managing money. It might have an impact on just the entire industry, but actually the industry's big. There's big pools of money, so it sort of washes out. The individual, it doesn't affect the whole.
Thank you.
Thank you. My name is Malvi from the Central Bank of China. Just wanted to reflect on some of the things that you said, Mr. Peter. Maybe the first one is just to perhaps get your thoughts on. You talked about the savings culture and the fact that the spending is probably the environment that you can control. From your experience, what percentage of what you earn is a good enough percentage to say? I know that more the better, but on average, for instance, if I say 20%, that's pretty much a good ratio. Just your thoughts around that. You also talked about time. One of the three things you talked about, time as a friend. And I think in your presentation you showed 5 years, 5 and 10 years, where there's a zero chance of losing your money. Pretty much like that. I'm just thinking for a trustee with a tenure, when you assume trustee, you have a tenure, some maybe 3, some maybe 5 years. And yet, time is actually a critical factor. But you only have 5 years. You're given a mandate to the trustee, go and ensure that we make money and so on and so forth. So how do you balance that? You need more time to make reasonable decisions, yet you only have a short time frame to realize certain gains. And yeah, just your thoughts around that. And then on the aspect of the market, I recall when Russia invaded, most of us thought it would just be something of a short-term thing, and yet more than 6-7 months down the line, there's still war going on in Russia. And as for some people, we've gotten used to going around about our way of business. Yet when it started, we were all shocked. We all thought, wow, the world's going to come to us now. Has the market priced that? You also talk about the prospect of Russia as another disruption. Can the market really get used to such disruptions and price it to an extent that even for you guys as asset managers, you're able to perhaps better position your policies to manage that? Yeah, just maybe your thoughts around that. Yeah.
Thank you. Cool. I'm going to talk about the Russia one first. And I like the fact that you pointed out when it started, everyone assumed that the Russians would be in Kiev within 2 weeks and the war would be over. And that was wrong. And that's an important reminder for everybody, is we all make assumptions and many of them are wrong. So as fund managers, our job is to be very humble, to accept that we can be wrong, and then how do we invest appropriately. So in terms of markets, what markets do is they're very good at seizing upon whatever is the current story. So, okay, it's Russia, and then they price it. And they're very efficient at that. What they're not as good at is looking at the long-term consequences of that. So if you think about interest rates, the facts change, you get an announcement, the bond market is already priced within 1 hour, and the interest rate markets, and then the shares within 1 day. So markets are quick to price short-term events, they're harder to price long-term events. And with the Russia change, I think, I'll give you an example, is when the Russians cut off the Nord Stream gas pipeline, gas prices fell. So it's the opposite of what you'd expect. You just stop the supply of gas and the price falls because the market knew that, it had priced it, and therefore it was known. I think the risks that are not priced is what happens next year if there's no Russian gas. Then that means a longer recession in Europe, worse profits. I think you might have another, say, 5% down. So I'm not sure that's priced. What's definitely not priced is peace. So any good news, and that good news doesn't necessarily have to be out of Russia, it could be out of Saudi. So if Saudi puts more oil into the market, then the oil price drops, then you get less inflation, less interest rates. The market at the moment, the global stock market could jump 10% in a week because everyone is underweight, everyone is cautious. So you could have like even 15%, like fast. So there's no good news priced. Yeah, so I'd say that's how I would be thinking about it. You can get into really big tail risks. So the Russians do a nuclear bomb. I'd say that's not priced. But markets very quickly react, and actually there's always stuff happening, there's always events, and markets, what you say is, it was a focus of attention, now we don't care. That happens all the time. It's a machine moving forward, and it's just continually pricing. Your second question was around trustees and terms. And for me, the question is not what the trustee term is. It's what is the end customer's term. And that customer, if they're saving, has many, many years to invest. So, as I said earlier, if you've just started at 20 or 25, you've got 50 years. Even if you're exiting the fund at forced retirement at 60, you've probably got 20 years where those savings have to work for you. So it's why you need to have growth assets. You need to. So I think the trustee's job is to not think about their term, but to think about the fund's life, which is actually permanent, because the people change within the fund, so the fund is forever. And I think the biggest risk for most people is that we become too short-term in our thinking. So we're worried about what's in our face, and we can't look long-term. It's why we have all this body of work over the last 100 years, is to force ourselves to think long-term. And that, so I'm not worried about people thinking too short-term, I'm worried about people not thinking long-term. So that, the trustee in that environment, I think, can take a longer-term view. And then I forgot your first question. It was about? There isn't a right answer. And that's one of the great because I'm going to inherit a nice farm. And it's, a lot of those assumptions are also wrong. So sometimes, there's an advice that old people should be very conservative in their savings. But actually, if they're not saving for themselves, if they're saving for their grandchildren's education, then once again they have 70 years to invest, because it's passing on to the next generation. So generally, having a plan is the first step. It's saying, what am I aiming at? So, when you're starting at 25, it's just start saving, do something. But maybe you buy a house and that's a better savings vehicle for that 5 years. But so you keep the amount that you're putting into your pension there, but you put more. It varies through your life stages. I think probably the most useful thing would be, I think a lot of people at 50 suddenly wake up and they look at their lives and they say, I've got 10 more years of work. So if you change your plan at 40, you've got an extra 10 years where you can make a difference. So there's no right answer. The 10% is the same as the tithe for the church. It's like an easy number that works for me. It's a nice church.
Yeah, we've got two more over there and one here.
Thank you. I think it is maybe directed to the regulator. We say that the province was with so much political tension in the country. Is it safe? And how safe is the people's money?
I'm glad I don't have that one.
Yeah. I think he's jotting it down so we can take another. He needs time to think.
Thanks to the speakers my first question was on the two-board system. Maybe my head was, how has that progressed in terms of becoming law? Secondly, Peter, from your presentation, I could not get, how do you balance opportunities in terms of crisis with prudence? Because clearly when we leave this book to say during crisis we should rush to things, then we are in for problems. Truman was the regulator. What sort of empirical evidence do we have in terms of the benefits of the 30%, which would then support another increase in their plan? Thank you.
Thank you, Mbenga. I was trying to find some nice English to frame the political question. It's easy to default on safety, and as a student of public sector economics, I used to read interesting elements between the balance of politics and economics. Get the economics right and we are able to sleep better. The investments that we have oversight over speaks to the environment that we live in. And the policy that comes from Hospital Hill and the pronunciations each year on a budget speech, they give the direction of how funds and how the investment space behaves in that annual turnover. We haven't had too much scares to be panicking at this point. I spoke earlier about strong fundamentals in our economy. Our Reserve Bank, the Central Bank of Eswatini, has been very cautious over the years. When you look what happened during the financial turmoil in 2008 and 2010, you did not see much losses and loss of value because you know that you go to a bank, you are going to borrow something, they want you to give them money first before they give you money. And we have been, as consumers, saying the banking system is too stringent and let's move to the non-bank sector. And on our end, we've been very slow in accepting dangerous products. And those that we don't understand, we prefer to take the heat of criticism as a regulator, to say you are not thinking fast, you are not responding well to innovation, but the sum total has been protection of the space. It gets a bit coy because as Fisoye and Peter are not going to say I guarantee you a 12% investment. But they're very good at putting up charts of what happened the past 100 years. And we rely on those charts and it makes us sleep better as a regulator as well. So when you say in 6 months I'm looking at making this much potential, then for us it's a worrying cause. We are from a IOSCO Investor Week. We've been trying as a regulator to take out information to say that if things are too good to be true, they probably are not worth the money that you want to put in. Yeah. So it is about caution, and given the history and the legacy that we have some amount of confidence to say we are not yet in those dangerous territories in as far as the investments that we have oversight of are concerned. Though the question was directed to Peter on the two-port system, we are looking as well as the regulator to see what is happening out of South Africa. On our end, when COVID hit, we took out a circular that was directed to employers to bring some sort of relief to their members, to members of provident and pension funds, to be able to withdraw an element, there were thresholds, limits, elements of their pension, but the business had to demonstrate that it was encountering some challenges so that they will be able to cushion their employees. So the two-port system tries to have a moderated sort of to say, I've been saving over many years and I need a bit of relief. Let me be able to access that. But we are very cautious as a regulator on that, because we then see that the 60 years that we have always aspired to hit, when we start work at 25, you find that you are still a young man at 60. And I mean, he's 50, look at him. In 10 years, he's supposed to retire. And it's no longer the environment that you then say, access your funds now, because once you come out of employment, and you will be expected to come out of employment because we've got a wider base of youth unemployed. So we do need to protect and preserve. The benefit of the local asset requirements that we put in 2008, we are, he was very smart, Mlangeni, and said empirical evidence. So we are in the process of trying to show that this is what has happened over the years in terms of the 30%. But we are quite encouraged because the largest funds have already, they are 40% already invested in the local market and above. So it's for us, we see the resilience, the funding elements, the funding rates, they are a bit healthy. Although we always hear 10 billion in PSPF, but there are legacy issues there. But we are quite confident that the run rates that we see in terms of contributions going in and benefits being paid out by the funds, they give us the comfort that the securities or the investment classes that we see in the country in terms of the 30% has brought the desired effect. Now it is for us to then to demonstrate, to say what could have been invested outside has went through this to these areas, these economic areas, and these are the benefits that we've seen before we then start enforcing aggressively the 50%. Thank you.
So I'm just going to answer the question around taking risk into, or adding risk. So we have a very simple philosophy around how we do this, is we look at everything, we have a process, which is what's the theme, which is what's the environment, what's the valuation, what's the risk, what's our time horizon, and then we go to our position size. So I touched on one part where I spoke about the price, where I showed the long-term valuation returns that we are seeing and how they're increasing. So a good example of that is on bonds, offshore bonds. It was negative, now it's positive, now we're starting to invest. But our position size is still quite small because there's still some risk that interest rates can go higher than we expect. So everything is a balance of those different areas. So the more the valuation is attractive, the more we lean into it because we take that longer term view. But we are also looking at what's the risk and what's the time frame. So at the moment, as an example, is global shares have fallen sharply, but in many cases they were expensive and have just reflected the higher cost of capital. So for instance, we do not yet see the US equity market as cheap. So therefore we are not buying shares in America as a result. But we are starting to see more opportunities elsewhere in the world where potentially the profits are low, the multiples are good, and the currency is also at a low level, giving us more confidence to invest. So, yeah, I think it's a good point. It's not a blanket buy whenever it falls. You need to also look at the facts, and the facts are very much around the valuation. And from here, we're starting to see very good valuations in South Africa, on South African assets. Most equity markets outside of America are at least fair value, with some showing good value, and America remains expensive.
All right. Thank you, Peter. Thank you, Mr. Jadjali. I will take one final round of questions. I am out of my time. And yes, we can go.
Thank you, Robert Director. My name is Sassi Kamin. My question will be directed to the registrar, regulator, and it borders around PPP. Maybe one would like to understand that in terms of PPPs, how the FSRA prepared itself, its supervisory function, taking into consideration the ethical or corporate governance issues amongst partners. When I talk about partners, including government and local governments, especially in such areas as public procurement. Because I'm asking this because obviously the FSRA will supervise pension funds and provident funds, but does that extend to such partners where there are PPPs involved? Thank you.
Morning. I have a question also towards FSRA or the regulator. I just want to check because obviously it's a question or it's a conversation that we had from the previous FSRA stakeholder consultation. Are there new instruments or internal controls that will be there as much as I hear there will be consultations regarding the 50? Who gets to be an asset manager? We've had so many asset management companies or service providers fail Yemaswati. So I'm just checking, are there other controls that you will put into place or you're looking to put into place so that in as much as we are moving maybe to the 50-50 split, is it safe? I think Babe asked, is it safe? Has there been evidence that it's going to work?
Participants and intermediaries in the space to ensure ESG reporting as part of the disclosure requirements. It takes much more impact when it is driven from the side of the funds themselves. But obviously we then get to influence that as well. We have investment guidelines that investment committees within the funds are supposed to follow and ensure that those governance loops are closed. Unfortunately, what we don't seem to have much handle on is, yes, members are represented through trustees, but we don't get the right balance that the members' demands or advocacy that would go around certain investments adhered to. From time to time, we'll get some feedback. The PSPF normally does. It's always easy for me to make reference to them because of their size and the weight that they carry in our economy. When they do their stakeholder touch base, it's not the right focus that we get from membership. Yes, because of the interest and the incentives that they will be looking to get out of the funds, so it will always be cost of living adjustments, inflation issues that need to be taken care of. But we don't get the right advocacy to say, we see there is an investment that we are about to make or that we have made in this space. We are not happy with it. How did it get about, and who and what justification or motivation came about. So as the wave on ESG reporting comes in, and integrated reporting, which some of our corporates are already taking up, it is then to show that what sort of social justice comes out of these funds that are held for the benefit of the members. And we hope that the conversations will pick up and also direct the trustees to the right kind of focus. I take that concern from the entry perspective, that when you are licensing a participant or an intermediary, how assured is the regulator that you are not dealing with a Madoff kind of individual, or someone that has failed in other space and has come. And these guys, they come in very nice suits, and their profiles, when you look at them, the company profiles and the LinkedIn profiles, they are always hyped up. And when we then have to go through the fit and probity tests, it has to be judgment. Now, this guy carrying a briefcase and looking quite sharp will come to the meeting with an attorney speaking the right language, and some negative issues that we may come to contact with will not be verifiable, or will not have been would have not come out from a court of law. So if someone says there are suspicions that individual AB has swindled an economy elsewhere, we touch base with that sister regulator. And it's been over the years, but things are starting to pick up now because of the risk and the pressure that has been placed on regulators to be firm on the judgment call that they have to make, even if there was no negative court case that came out pertaining to that individual. So the regulators, we've walked a journey where we are now saying we are signatories to multilateral agreements that are saying, regulator to regulator, we can be able to say that, yes, I dealt with this individual in my space, as much as compliance issues were never finalized, but I would advise that you tread with caution. So regulators have been quite difficult in giving that kind of comfort, because when we look at our own space, we are not going to have information that is going to be verifiable and direct your attention to make that decision to bar that individual. There are certain we have a fit and probity rehabilitation criteria that says we hold the right to decline an application of a certain participant. So we always then have to fight against the political forces that probably these guys may come with, and the AML controls have assisted us in that, because what it then does is to open the veil on the ultimate beneficial owner that comes in to claim that they are going to be the shareholder or the director. So we're able to pick through a trust and open the veil to see who ultimately benefits. And it's been interesting to see that it's just individuals and their children and families sitting in very exotic locations, and the holding companies that they are coming in with here have got links with tangible entities that we can refer to the, well, not Old Mutual, but I'm just making an example. Yeah. So the links that they come in with are well-to-do individuals and entities that you cannot doubt as a local. But when the trouble then hits, you then realize that probably then the controls and the entry issues that you have to look in, you have to strengthen. And the AML legislation and subsidiary legislation is assisting us to ensure that we clamp down on those undesirable individuals coming into our space. Thank you.
Thank you. Okay. Gentlemen, thank you very much. I think you have been very, very brilliant. Ladies and gentlemen, I think this puts me at the spot where I say it's now after my Shaila time, and I want to now, you may remain seated over here while I invite the CEO, Old Mutual, Babe Muzibel,
to come and give us his closing remarks, and thanking you for being here with us all this time. We truly appreciate it. Thank you.
MC, no man, Shaila, Good morning, ladies and gentlemen. Mr. MC, I was supposed to speak at 10, so now it's 10:30, so I don't know. Yeah, but I'll be very brief. So my role here is just to appreciate our guest speaker, Mr. Peter Brooke. Thank you so much, sir, for coming. I understand it's your first time to be in the kingdom. And also appreciate Mr. Njaljal, our FSRA regulator. Thank you so much. I understand you had a competing diary, but we are very privileged to have you here. And also our MC, Simshale Ntandla. You've done a great job. We are not going to come back to the podium now. So, also to appreciate Sviso, been doing some research. I didn't realize I've got a political analyst in the office. It's been a pleasure to be with you this morning. I've seen familiar faces, friends, cousins. I have my Kaya on the other side. Members of the media, thank you so much for showing up. As usual, you always show up on time. And colleagues, maybe let me introduce our colleagues so you can appreciate them. Members of ESCO, I've got Nosmilo Smelani. You may stand just so they can see who Nosmilo is. Maybe let them all stand at once. Boom. 1, 2, 3. Nozipo, then I've got Nozipo Dlamini, Mgisi, Mgisi Matsebula. Who else is here? Nowanda Dlamini. Please show up. Am I missing anyone? Okay, some are in the office. So Nowanda is responsible for customer and marketing. Gisi is operations. Nozipo is business development in corporate. So I think that's the person you usually interact with. And Nosmilo is our CFO. So I've got other colleagues that are not with us here. Yeah, so just to summarize, I think you have found this very insightful. I want to believe it was very insightful. Thank you so much. You gave us 5 or 6 pointers. Time is our friend. Falling markets may give good or may be good for future returns. Okay. I was capturing some notes. We need to watch out for inflation. You gave an analogy, an example that the price of beer 30 years ago was 1 rand, one lilange, and now it's 15. Yeah, well, our MC was saying he wants to hang out with you. I kept listening to him say, I want to hang out with Peter. I don't know whether it's for the beer or it's for... Okay. And then lastly, the power of compounding. I think that is quite very insightful. But I just want to touch on the role of trustees, because most of us here hold the roles of trustee, including myself. I'm a trustee in one of the umbrella funds. And listening to what the regulator has been saying, that we need to support the local investments. So there has to be a journey, though. You know, we can't just, it's like ramp up to 50%. You know, our capital markets are not liquid. So we want to believe that you are thinking of a journey. So we're at 30% now, so we can then, move progressively and not just jump the gun and suddenly sit at 50%, because there is a culture that most trustees invite consultants from across the borders. They critique almost everything that we try to do locally, especially the greenfields. They will tell you this is not going to work. They compare it with what is happening in developed markets. When we become stuck, that is the challenge. But I think as trustees, we need to be a bit flexible. It is not easy to create, these local assets. Unless you are going to buy a shopping complex that's already there, but to start a greenfield, it's not an easy thing. There's a lot of school fees that you need to pay on the way. We're all learning, but as Old Mutual, we assure you that we will rope in the professionals and the resources to drive these local assets. I bridge that gap. If you give us a chance, of course, a mandate, we'll ensure that we deliver that. But we need, because the other tendency is having this short-term view. We see it in many of our report backs, that whenever the equity markets, they take a dip, then that report back becomes very emotional. But what Peter was saying is that, if you look at it 6 years later, you recover all. 10 years later, almost double. But if we manage it on a day-to-day basis, I think trustees don't want to rock the boat. That's why most trustees don't want to make decisions, that they could be asked maybe the following year, what were you doing? Somebody spoke of a tenure. He said, the tenure is too short sometimes. But we need to take the long-term view. I think that is very important. I think, maybe let me stop there, and I am conscious of time, and just appreciate our speakers. The colleagues have prepared some gifts for my boss here, the regulator. Mr. Regulator, the industry is hungry for you. I was judging by the questions that were raised. We need a stakeholder forum. Agree? Yeah, and this is for who? Oh, Mr. Regulator, thank you so much. You didn't bring your PA here, so you have to come and declare it to your board. Yeah. I have to. Did you catch a very good one? No? What did you say? Oh, all right. Thank you so much. Yeah. And then this is for Peter now. Oh, okay. Mr. Brooke, thank you so much.
Looks exciting.
Very much so.
Thank you very much.
All the way from the kingdom.
Ah, now this is excellent.
And then? Okay, I need to give way now because there's some ritual that is being performed. Yeah, this will be a great memory for Peter having traveled to the kingdom. Sfiso, I don't have anything for you. And to our MC, you spoke about the paycheck. Oh, this is for? Oh, the MC. Okay. Mr. MC? Yes. They changed their minds. Thank you so much.
Thank you.
Come this side. Yeah.
And only here for me. No,
oh, they're still. Okay, so you can hang with me for now.
I'm excited to have a picture.
Oh, okay. Yeah. Wait.
Ladies and gentlemen, while we do the photo shoot, can we have lights? I have been asked also to say indlela yendlula ngasekhaya noma besingekho nje emgwabeni, but there are some hampers for all of us out by that side on the left. Okay, and that we would like you also to stay on just a bit. We would like to have a photo call with all of you and our guest speaker. So ningahambi ke kunene.
Finally.
Okay. Yes, you may come. I thought you had done. No.
Thank you, Simon.
Yeah.
You're nice and kind.
Yeah. And then to my MC. Yeah. I've been, what now? The music. Sebastian. Thank you so much. All right, colleagues, I think my MC has given the final directions, but I just want to say thank you so much for coming. May the peace that surpasses all understanding guide your minds and hearts. Have a great day. We'll see you again. Thank you so much, colleagues.
Happy Valley ngethemba ukuthi nithokodele ihlelo lakhona ka Old Mutual futhi ke senivile ukuthi batshala kanjani imali futhi nikhangekile nalabo labanye labangafisa kuba ngoke ma investors lapha ke la khona ukhona Bex Sangambuli Chico, ukhona Linda Shongwe, ukhona Siyabonga Dlamini kanti ke lo sinikise la Thombetethu emakhaya aphenza sihlanganisele nguyethu kusamamba estudio ukhona Cebile Njangase nami sengimfisela usuku loluhle logcwele tibusiso ngisalani kahle.